Okay. So, okay. So we're gonna look at Euro Japanese yen, right? So when looking at when doing scaling in, one of the most important thing that you have to know is that like you have to look at the distance in which the market travels from your first entry. So for example, let's say that this is our initial entry, right? So here, this is where we had our first entry, right? So this basically scaling in is basically a method that you can use in order to turn a small account into a big one, right? So because turning a small account into a big one, it's actually like something that's very challenging amongst retail traders, especially when we're starting. So because most of the trading advices that we get online, they don't really show us how to grow small account, right? There's certain principle that they advocate that sounds good, like, okay, you can do this to increase your account or grow your account very fast. But when you try to implement those things that they are suggesting, you end up like making a loss. Like you don't really make money in terms of like the way that they explaining to you, right? So if you were to trade this pair, right? Let's say this is where you had your first trade. This is where you had your first trade, right? So when you start off placing your initial trades, you will basically use your standard loss. So for right now, let's say that you have an account of $100, right? So obviously on $100 account, you know that your first trade should be 0.01, right? And the thing about like trade using scaling in that is that like scaling in requires us to find a pre-existing trend or a movement in the market. And then what we do is that we place multiple trades onto that pre-existing trend again. So with each successive trade being placed at a higher amount than the last one. So this is, if we place here our first trade, so this will be a second trade, which is higher than our first one. So our first, our first trade, then our second trade will be slightly higher or even higher than our first one, right?
Yeah.
So like usually like that's why I say that like our first trade usually consists of our normal lot size. That's the lot size that we're gonna use. We're gonna use a normal lot size like 0.01, right? So once you start building up momentum, that's when you start thinking about increasing lot size, because you'll be placing your second trade at a higher leverage than the initial one, than the first one. So you'll be placing it at a higher leverage, at a higher position, at a higher price. You see? So now after placing the second trades, now you've got up. Now let's say maybe this is your first trade, this is your second trade, right? So after placing your second trades, now you've got trades that are running, right? But remember that the second trade will make more money than the initial trade, right? Because on the second trade, what you do is that you're gonna increase your lot size to 0.02. You want to place it at a higher leverage, therefore making more money, more like the distance it took for this price, the market to push upwards, the same distance that the market pushed upwards. Let's say maybe here you made for example, let's say you made $20, right? So half of this amount using this lot size, you'll make $20 with the market traveling half the distance in which it traveled on your initial one, right?
Yeah, yeah, yeah.
So those are one of the things that you have to take into consideration when trading, right? So now, and then the other thing that you have to know is that when you place the first trade, you have to use profits that you have made from your, when you place the second trade, you have to use profits that you have made from your first trade, right? Similar to when you place the third trade, this is, let's say here you place your third trade, you have to use profits that you have made from your first and the second one. That means whenever you place your orders, you have to account for the profits that you have made, right?
Yeah.
So the size of the third trade, it's determined by the profits that we have made or the profits that we have taken off from our initial first two trades, or our first two trades, right?
Yeah.
That's the only way we can determine the third trade's position, like the lot size, especially the lot size as well, right? So because the other thing that, let's say maybe they say that the distance between the stop, like we're looking at the distance between our stop loss here the stop loss, the first stop loss and where we firstly entered. So we must firstly account for that one. So let's say the movement from here to here gave us $20, right? So when we place, let's say maybe when the market retraced here, we are left with 10. Let me just erase everything. So let's say first trade, second trade, right? So on our first trade, the movement pushing here and after it retraced, we have $20 in profit, right? Let's just say we have $20 in profit. So for us to be able to place a trade here, that means we must account for the $20 profit. We're gonna use the profits in order to place the trade here. So let's say maybe when we bring our stop loss here, or when we bring our stop loss here, this is $20, right? And then when we place a trade here, let's just do this. When we place a trade here, that means the stop loss that we're gonna place must be minus $20 because we're already $20 in profit. So we need to see the stop loss be minus $20, right? Irrespective of whether we have increased our lot size to 0.02, our stop loss has to be on minus $20. It cannot be more. Because once we have this $20 plus the minus $20 that we actually have from our second trade, therefore we know that once this one gets triggered, we are in $20 profit. And then once the market continues running down to the downside and triggering our stop loss of our second entry, we have minus $20 plus $20, right? So 20 plus minus 20, we have 0. So we end up being at break even. Do you understand what I'm trying to say?
Yeah.
Okay. So we'll be at 0.00. So we haven't lost money, we haven't made money, but if we have made, like I'm just saying, for instance, if the market breaks below, right? But if the market rallies to the upside, but the price pushes to the upside. When the price pushes to the upside, remember that this distance it takes to push to the upside, right? Let's say maybe when the price is here, we have plus $40, right? When the price is here, you see, when the price is here, we've got plus $40 from the first trade, right? And then we've got here, because the market moved the same distance as the initial movement, that means here we've got, on the second trade, we've got plus how much? Plus $80. Do you see it?
Yeah.
So we've got $40 from the first trade, $80 from the second trade.
So at the
Yes.
newest higher high, we have double money.
Yes, okay, like repeat what you just said.
I said that at the newer highest high, we have double money.
Yes, we have double the amount of money. We have made double the amount that we made on the first trade. So you see, we've got 80 trades running rather than having just one trade rallying up and then giving you 40. When the market makes swings, you add entries and then push price to the upside. But yet at the same time, you increase the lot size while minimizing the losses. Like you keep the stop loss as proper as possible so that it can be absorbed on your thing, so that it can be absorbed on your first trade. So your first trade gets absorbed. The first trade's profit absorbs the shock or the losses that are made on the second trade.
Okay.
So you understand?
Yeah.
Okay, so now, right now, let's say after that, making this one. So now we see this push to the downside, right? We want to place our third trade. So when placing the third trade, the most important thing that we have to consider is that we have to consider the profits from the first trade. So when you're scaling in, second trade's profits, they are not, those are not, you're not focusing on them when placing a trade. You focus only on the first trade's profit, not the second, third, fourth, irrespective of how many times you add positions. Whenever you calculate your stop loss, you use the first trade's profit only. You understand?
Yeah.
So basically, let's say maybe on the last trade, the third trade is our last trade. So when scaling in on the third